Good morning, everyone. My name is Lisa Pearce, Head of Distribution and Marketing at Totus Capital. Welcome to another one of Totus's regular investor updates. Something a little bit different this time. We have McGarry and Tim Warner hosting from San Francisco, where they're at the Morgan Stanley Tech Conference. So I'll hand over to Ben and Tim now, and I'll come back for questions at the end. Feel free to submit any Q&A via the Q&A box at the bottom of your screen.
Thank you, Lisa. Hi, everyone, and welcome to our 6-monthly webinar. As Lisa said, I've got Tim Warner here with me in San Francisco. Jack Cherry, our analyst, is downstairs busily taking notes. The conference is ongoing, and we have Hamish McIver in Sydney with Lisa. The format of the webinar will be familiar to most of you by now, but with the Alpha Fund turning 10 years old at the end of this month, we thought we'd start with a report card on the fund's first decade. After that, I'll take you through a quick reminder of the objective and expectations for the Alpha strategy, update you on the Totus team. Tim will then talk about recent performance and current portfolio positioning. We'll highlight some key themes in the portfolio and hopefully leave plenty of time for Q&A. Okay, the Alpha Fund turns 10 years old next month, so it's a good chance to look back on the objectives of the fund when we set out and what we've delivered so far. My objective when starting the fund was to focus on performance, both capital growth and income, and capital preservation at the same time. Making money is only half the battle. Keeping it is the other half, and sometimes harder half. We're committed to doing this by investing in listed equities and related listed securities, and we would invest our own money in the fund alongside our clients and reinvest performance fees along the journey to maximize alignment with our investors. We wanted a fund that could perform regardless of economic or market conditions, while always holding some hedges against unforeseen market events. I'm pleased to report that on balance, for the first 10 years, we've achieved these objectives. Since April 2012, we've delivered a strong return of over 15% per annum, net of all fees and charges, versus the index of the top 300 Australian shares, including dividends, which compounded at less than 10% per annum over the same period. These returns have been uncorrelated with Australian and US equity markets, with performance often delivered during bouts of market volatility, such as during the European debt crisis, the COVID panic in Q1 2020. This contribution during periods when other asset prices are falling provides a valuable source of diversification and risk mitigation for our clients. Alpha Fund drawdowns since 2012 have been within expectations and have always been recovered within a reasonable timeframe. Our drawdowns, when they have come, have often been at different times to broader equity market declines and to our major Australian hedge fund peer group. Totus is one of only a handful of funds, long only or long short, to have never experienced a 20% drawdown over the last 10 years. The Australian market and the US market have each experienced drawdowns of over 20% during that time. And importantly, those market drawdowns came at different points in time to the drawdowns in the Alpha strategy. Our portfolio often zigs when the market zags, which is what it is designed to do. Internal capital from my family and Totus staff represents 9% of firm assets, a number that has compounded nicely in absolute terms alongside our growth in assets under management. This investment provides our business with a strong financial foundation to support our next decade of performance. As a reminder about our Alpha strategy, we're basically a long quality, short, low quality portfolio. We believe that good companies with tailwinds, economic moats, high returns, that are profitable, generating free cash, with management that does what they say they're going to do, will tend to surprise positively over the medium to long term. And against those high quality businesses, we hold a portfolio of companies that are experiencing headwinds in highly competitive industries, generally with low profit margins or low returns on invested capitals, often expensive in complex industries, and we look for catalysts for the market to focus in on those weaknesses. What makes us different is that since 2012, we have materially outperformed in down markets, whilst also delivering solid returns in up markets. This combination of positive returns during ASX down months and positive returns during ASX up months on average has delivered superior uncorrelated risk-adjusted returns over 10 years, nicely ahead of the overall market. This chart just looks at where our returns come from. The dark blue line is our long portfolio over the journey, 10 years. The light blue line is our shorts. As you can see, the bulk of our return comes from our long book. We find high quality companies and attempt to own them for the long term. The light blue line is the performance from our short book, which is over the journey showing a small loss since inception. The value that the short book delivers is during tougher periods for markets such as 2015, the start of the pandemic in 2020, and also the start of 2022, where it provides a beautiful offset to periods when our longs are not performing. We talked about this in the last webinar, but if you own the alpha portfolio alongside a long portfolio, we've taken here the ASX 300, including dividends. If you owned an equal portion of each over the last 10 years, you would have achieved a result that was lower volatility in the portfolio than the overall market, with lower downside risk and higher long-term returns. Achieving this long-term investment performance requires a long-term mindset. In order to enjoy the performance and diversification benefits of the alpha strategy, you need to be there for the journey. If an investor comes into the fund after a strong run of performance and leaves 6 or 12 months later after a weaker period, they have had a bad experience, and so have we. The fund has had 2 down years in the 10 years since inception, and both have been followed by strong periods of performance in the subsequent years. The bounce backs that the fund enjoyed in 2017 and 2021 were much stronger than the drawdowns the fund experienced in 2016 and 2020. We urge our new and existing investors to adopt a long-term mindset, ideally 5 to 7 years, to any investment in the alpha strategy. I tell my friends and family that a good way to avoid a poor entry point into the fund is to average in over time. Buying the dip in the alpha strategy has been one of my best investments. Turning to the team, since our last webinar, we've hired Sophia Sang as our Manager of Compliance and Operations, and we've expanded our research team to 4 full-time members, with Hamish McIver joining after doing an internship with us in 2021. I'll now hand over to Tim to go through our recent performance.
Thanks, Ben. So Ben has run through the since inception journey of the fund so far and shown how the returns have been generated at very differing times to the market. So we thought it would be useful to run through our performance since pre-COVID and illustrate how the fund has performed over that 2.5-year period, and highlight how we managed to generate alpha and, true to form, the returns that come during times of market stress, and hopefully will continue to in the current market volatility. For reference, the chart on the left is the Totus Alpha Fund performance net of all fees versus the ASX 300 accumulation index. And the chart on the right shows the long and short attribution of the Totus Alpha Fund since January 2020. So starting back in 2020, whilst a distant memory from now, it started incredibly well for the fund, with our short book offsetting the losses in the long book, protecting clients' capital and generating meaningful alpha in a time of severe market stress during the COVID sell-off. Off the back of the sell-off, extreme government stimulus, and a world where the cost of money went to zero, story stocks and unproven business models were given the benefit of the doubt, and these were the types of stocks that we typically short. The strategy, unfortunately, subsequently underperformed over the balance of 2020, Our longs did well, but the quality cash generative companies weren't as appealing than the dreams and promises of many questionable management teams. Moving on to 2021, we recovered all the underperformance of 2020 and outperformed the market by 9.5% for the year. While story stocks and unprofitable tech was still the flavour of the month at the beginning of 2021, a degrossing of our short book helped manage the risk and avoid crazy short squeezes in meme stocks. In the back half of 2021, the puff began to run out of the bull market frenzy of story stocks, and a flight to high quality, cash generative businesses became evident, which led to very strong performance in our long book, and our shorts were no longer an anchor on the returns. Finally, 2022 has come around, and it's begun with central bankers indicating that inflation was no longer transitory and interest rate rises were imminent. Global equity markets have begun to sell off on the back of this news, and added to the mix, the recent war in Ukraine has created even more uncertainty. To the end of Feb, we are only down around 1% versus global markets being down anywhere from 5 to 15%. The book is doing its job, and we believe we are well positioned for further volatility.
Thanks, Tim. With all the recent turmoil, you might be surprised to know that we are currently enjoying some of the easiest financial conditions this century. US and Australian interest rates are stuck at historic lows, and the Federal Reserve is still doing quantitative easing. This is all about to change. Politicians have recognised the impact of inflation on voters, and Chairman Powell has committed to stop buying bonds and to start raising interest rates this month. This effectively tightens financial conditions. On your screen, you'll see two areas on this chart circled in red, which show previous episodes of tightening financial conditions. They haven't been strong periods for equities, but they were strong periods for the Alpha Fund. In both periods, the fund delivered solid positive returns and material outperformance versus the ASX 300 index. Looking at global earnings revisions, they have already turned negative. Higher interest rates, the end of QE, the commodity price spike, and the supply chain shocks are still to come. Ideally, we would like to see these earnings revisions start to get less bad before getting more constructive on markets. The last observation is that history doesn't repeat, but it does often rhyme. We're not trying to scare you here with this chart, but there are some eerie similarities in the current market with previous market peaks. For example, the chart on the left shows the Asian crisis and the long-term capital management collapse in 1997 and 1998, which led to bailouts by the IMF and stimulus from the US Federal Reserve, which contributed to the dot-com bubble in 2000. The chart on our right is the NASDAQ and our current market, and the similarity sticks out with the huge stimulus that was injected around the world to battle the COVID 2020 pandemic, and then the high-profile fund and investment bank mishaps that we've experienced on the way to the current peak. Turning to reporting season, our observations from the Australian reporting season that were as follows. A number of companies reported subpar or poor cash flows as a result of building up of inventory. Pressured supply chains and this build-up of inventory also resulted in input cost pressures. We saw continuing declines in e-commerce sales and increasing marketing spend to acquire new customers. In general, retailer margins appeared to be coming off what looked to us to be cyclically high peaks. The spot strength in commodities was already evident, and resource companies were experiencing earnings upgrades, paying out big dividends and buying back shares. Many companies avoided giving out earnings guidance and in some cases removed existing earnings guidance. One thing that we think could potentially be a building issue for Australian and US stocks is share-based compensation. It works beautifully to incentivize staff and retain them when share prices are rising, but does the opposite in a falling share price environment. One of the key takeaways is that after a few years with the market focusing on revenues rather than earnings and earnings per share, actual profits started to matter again. Companies that beat on revenue but missed on EPS were sold off.
Looking at the portfolio and the thematics on the long and the short side, the majority of the themes are most likely familiar to a lot of you, so we won't go into a great detail. However, we encourage you to ask questions in the Q&A if you have any. The core long themes such as digital transformation, bricks to clicks, and the cashless society continue to be the backbone of the long portfolio. The weighting to tech exposure in these themes is offset by our index hedges, as well as the unprofitable and expensive tech positions. On the long side, we have added to some Australian mid-cap value positions, such as Smart Group, which is an old favourite, which are trading on mid-teens multiple and should see the resurrection of earnings growth after a tough few years throughout the pandemic. And a new thematic added to over the past couple of months is undersupplied commodities. We have done well out of iron ore historically on the back of the supply shock caused by the Barley Dam collapse. And we are seeing similar supply issues occurring in energy-based commodities currently, and have exposure through a range of these positions. On the short side, we continue to do well out of shorting buy now, pay later, especially tier 2 players with zero competitive advantage. And we've added to themes such as underperforming active fund managers and companies facing supply chain and inventory issues. These themes lead to a portfolio that looks like the following. We're currently running around 40 longs and 80 shorts. We have increased the short book since our last webinar and added to a bunch of the short thematics. The portfolio is constructed to have more concentration in our longs, with the average position size being about 3 times greater than a short, as we spread the exposure of the short book to limit the risk. True to label and our investment philosophy of investing in quality companies and shorting bad companies, the return on equity, a financial metric used to assess the quality and profitability of a business, is substantially higher in our long book compared to the short book. And whilst these businesses in the long book are much superior than the short book, the overall valuation is actually lower. We have to note though, a lot of our short positions have negative returns as they are unprofitable, and the average PE ratio may be understated as they don't even have any earnings.
Thanks, Tim. So in summary, we've just been through a difficult period for fundamental long-short investing. Zero interest rates, low inflation, and central bank money printing sent story stocks and unprofitable businesses to the moon and sent many of our competitors in the long-short investing business out of business. But times have changed. Over the last 12 months, our short book has again been a major contributor to fund performance, and so far in 2022, it has contributed all of our performance. When the good times end, quality businesses do get impacted, but they feel difficult times a lot less than lower quality businesses do. Tough times are when good businesses take market share, get into fighting shape, and set up for the next leg of growth. With profits from our short book, we have a chance to buy these businesses while they are on sale. This environment is tailor-made for our alpha strategy. Over the last 10 years, we've made some mistakes, but we've also learned a lot and are better investors for it. Our team at Totus is young, energized, and working well together. Tim and I have the bulk of our personal capital invested alongside you, our clients, and we intend to make the most of this opportunity-rich environment. I'll now hand back to Lisa for some questions.
Okay. Thanks, Ben and Tim. So we now have a good amount of time for some questions. Thank you to those who have sent through some already. Please continue to do so by submitting any in the Q&A button at the bottom of the screen. Firstly, I want to say it's good to see that you've been able to travel overseas and to be on the ground for the conference. And given that many companies that are in the portfolio, both on the long and short side, are presenting there this week, can you provide or share with us any key observations or takeaways from the first 2 days of the conference?
Yeah, we sure can, Lisa. We're halfway through the tech conference, and we've taken 3 of the team over here to San Francisco because we thought it would be a great chance for us to see not just a good chunk of our long book in names like just today we've seen Alphabet, Microsoft present, for example, but we've also got an opportunity to look at a range of companies we've used to offset those longs in our short book. And check the temperature of the US investor base and the US tech industry in general. And I think from what we've observed so far, I mean, it's still quite a fully invested bull market in tech in terms of investor interest. This conference has 1,900 in-person participants spread over 4 days. There are not that many long short investors here. The vast bulk of the investors here are long investors. There are certainly some nervous investors and a sense, particularly around the unprofitable or low margin cash burning businesses, that the pressure is on a little bit more than it has been in previous years to justify share prices. I wouldn't say that it is panic stations yet. There is no talk about layoffs or redundancies in the tech business. There is, people are skirting around the issue of share-based compensation, which is how many people in the industry are remunerated in the tech business by getting issued shares in their companies. Staff retention is going to be a major issue for companies that have share prices down more than 50%, because and that we think that that's potentially a positive for many of our cash generative companies, the likes of Microsoft, Alphabet, are able to pay in cash and have stock that has performed a hell of a lot better than less profitable businesses where the share prices are down a lot more. So in terms of cycles that I've seen in my career, this is a conference that I would consider is indicative of previous peaks. I was lucky enough to work at Morgan Stanley in 2000, so have the benefit of 22 years gap between 2 tech conferences, and there's some pretty interesting similarities between this conference and that tech conference I went to back in London in 2000. And having been through a couple of cycles in resources as well, certainly full houses and and no short sellers in the crowd is not a sign that we're anywhere near the bottom of this current tech sell-off.
Speaking of the tech sell-off, given you came into the year quite exposed to tech, big tech names, did you reduce any of these individual positions over the last few months, or has your thesis changed on the likes of, I think, Amazon, Alphabet, and Meta are some of the top positions?
Yeah, look, the 2 that were reasonable positions coming into this year, where there's been enough of a change in the environment for us to cut back positions, have been Meta and HelloFresh. Both of them have experienced, severe share price sell-offs this year. We still like the prospects of those businesses over the medium term, but our process dictates that we look for tailwinds for industries, and things like food price inflation and economic disruption in Europe is certainly falls into the headwind bucket for a company like HelloFresh. And Meta of the big tech is probably, in a weaker strategic position than some of the other names that we hold in our portfolio. Having said that, both, we did sell a chunk of our position in both those companies, and with the share price falls, you're looking at 3 to 4% positions for each of those companies now in the book, which we think is very manageable. And in the case of a business like Meta, we're back to, on any metric, reasonable valuations for a company that is still generating a ton of cash, buying back a lot of stock, is a key channel for small businesses to advertise and reach their customers, and show new products into their customers, and for people to connect around the world. So I think sentiment for Meta is close to as bad as it could be for any stock that I've seen over the last 5 or 6 years, and I don't think it would be surprising to see that change very gradually at the margin over the next year or so. So they're two names that we've trimmed on the long book. And
just to add to that, on the short side, as we came in quite tech exposed, we did still have our unprofitable, expensive tech positions on the short side, which, as the environment began to change, we quickly added to those positions, which have done well as a hedge. So that's just some color on the short book.
Yeah, there's certainly a lot of businesses now, that have a chance of running out of runway as capital gets more scarce. We've just been through the best possible environment for unprofitable, low margin, cash burning companies, and if they haven't been able to sort of get through that journey and on a trajectory towards funding their own growth, they could be in a lot of trouble if this downturn extends. So we've looked at companies like Uber and Lyft and added back to short positions in those kind of names.
Mm-hmm. And someone's asked, in the recent earnings seasons in the US and Australia, were there any standouts or surprises, whether good or bad or disappointing? Were there any businesses that you added to?
Look, I suppose since the last webinar where we were cautiously optimistic, we've gone to a cautious stance on equities. So we haven't done a ton of buying in the book since the last webinar. There are a couple of places where we've added exposure. Tim mentioned Smart Group, a business we've owned in various sizes over the last 6 or 7 years. That certainly was a very clean result. They've gone through an IT reinvestment phase and have now, which is starting to show tangible benefits in terms of efficiencies, and they now have a nice platform to grow from. So that is a sort of cheap domestic reopening play that we understand quite well. So we've added to that position. And the other obvious space that we've added to is commodity space, where Australia is really well positioned with a range of things that the world is in short supply, and simplistically, owning commodity stocks where the spot prices are well ahead of where the market has their earnings forecasts, is a great way to make money. We made a lot of money being short commodities from 2012 through to 2016 when the reverse was true. And, we've got all the ingredients here for a very strong environment for a range of Aussie commodity stocks. So we've taken that position up. We had, so we own, energy related commodities, and have had a position in a company called Capricorn Metals in gold, which we still own and is performing beautifully.
And then on the big tech space, we haven't really added to any of the positions, but reporting season, like Microsoft, Alphabet, and especially AWS within Amazon, all had cracking results, which we're very happy with long term. And then our positions across the Aussie mid-cap space, such as Dicker Data, Ben mentioned Smart Group, Objective Corp, haven't added to them because except Smart Group, they're at their full position sizes, but we're comfortable with them. They're reporting well, they're delivering, and they're executing.
Yeah, so I mean, one thing on that mega cap tech exposure is that in a more difficult economic environment, or an environment where markets like Russia and China become difficult for Western companies to do business in, big tech already had a very limited exposure to those those areas of the world. They're very cash generative, very good market structures. They to us look a lot more defensive than they have, at periods in the past. I think at the moment the liquidity is just draining out of, the tech sector. But at some point, we think that the quality of those businesses will mean that there is a price for them, and that they should, the prospects for over the medium to long term are still very strong for those mega cap, reasonably priced tech names. But admittedly, it's tough short term.
We know that you flagged concerns with the buy now, pay later sector for quite some time now, even as money flowed into this fad stocks like Afterpay and Zip. Now times are tough for that sector, and you've done well out of this, I'd say. We've also seen acquisitions in this space. What are your current thoughts on the opening of the NPL, and do you actually see a future for these stocks?
Look, it's difficult to, we're in the right place to learn more about it. We saw PayPal present today. They had talked about in the presentation today looking at acquisitions in the buy now, pay later space, just given how hot the demand side of the equation was from consumers, and decided to go at it organically. And in the countries that they've launched buy now, pay later, they're in the top 3 or 4 providers in every country. So without having to spend a cent, they were able to get a market leading or close to market leading position in all of the markets that they targeted. So that tells me that one, they didn't find anything that was attractive enough to buy, at the time they looked, and two, that organically the barriers to entry are not that high. So we've already started to see combinations that look extremely defensive or desperate, of companies like Zip and Sezzle. And I think putting two low quality cash burning businesses with questionable market positions together is unlikely to result in a high quality business that's I think they're really shifting the deck chairs on the Titanic. So yeah, we maintain shorts across that space. Even the pretty companies in the sector, the Squares, which bought Afterpay, a very high profile deal. If you look at something like Square, even before you put the Afterpay business into it, when you strip out the amount of shares that they are paying their staff with, that business wasn't even profitable standalone even before you put Afterpay into it. And now we're heading into an environment where the US consumer and the Australian consumer is facing, higher costs for everything from filling up the car to buying the groceries to paying the mortgage. So, it could be, it's difficult to see how the environment gets any better for buy now, pay later over the next 6 to 12 months.
We've had a few questions around in light of the war in Ukraine, and we've seen a sharp rise in commodity prices driven by supply concerns. And you touched on a bit about commodities and resources, but have you been building your gold exposure in light of this? Or can you expand on your undersupplied commodities theme? Yeah,
look, the war in Ukraine is, potentially a black swan event. I'm always a little bit glass half empty, and do tend to sort of, not catastrophize, but I'm cautious around events like this. And we were relatively cautious about the impact of just the Fed starting to increase interest rates and remove liquidity from quantitative easing in this environment where inflation is no longer transitory. It's pretty intense. It was before the war in Ukraine. the most intense period of inflationary pressure that we've seen in decades. And that's quite different from the setup to other periods, over the life of the fund, where the Fed has talked about tightening interest rates or removing or stopping quantitative easing. I think they're in a really difficult position at the moment because, the voter and the man in the street is really hurting from these inflationary pressures. And I think the Fed and the government over here in the US has said, you need to get this inflation issue under control. And then along comes the war in Ukraine, and you throw, incredible supply disruptions into the mix in, the basic sort of building blocks of our global economy, things like coal prices, oil prices, wheat prices. Last week we had the coal price up 45% in one night. Last night, the nickel price, which you need to produce cars, batteries, electric vehicles, was up 250% before they stopped trading on the LME. So look, I don't want to, panic people, but the ingredients are all here for, a very big supply shock at the same time that we've got relatively full valuations. The Fed, it does not have ammunition to lower interest rates any further. And if they started to buy bonds or print money into this highly inflationary environment, that has potential to, that's like putting fuel on a bonfire. So it's a really difficult setup for markets. Now, the longer that difficult setup goes on, historically the fund's done better relative to overall equity indexes, but it's going to be a bumpy ride. And if we can produce positive returns in this environment, we'll be very happy.
What is your current net exposure in the portfolio, and do you have a floor to your net exposure? Like, would you ever go net short? The investor asked.
Yeah, we have been net short at times in the past. We've taken the view that we will try not to go net short, and the reason for doing that is that the volatility of our longs is much lower than the volatility of our shorts. So we've averaged 38% net long exposure over the 10 years we've been running, and that 38% exposure has given us a beta to the market or a correlation with the market of 0. So if we take that exposure down into negative territory, we effectively have an inverse correlation with markets. So if we went from to a 0 net exposure, we would be making money on down days, potentially, theoretically, a 40% negative beta to the market, which would mean that, if the market went up one, with us with a 0 net exposure, we would be losing 40 basis points, or conversely, if the market fell 1%, we would be making 40 basis points. So look, we have, with the Ukraine situation, certainly not looking any better, and the current spikes in commodity prices, we've reduced our net exposure from the 30% that we had at the end of February and are currently sitting in the mid-teens. That means that when markets sell off, typically we're making money. So yeah, we're at a pretty cautious net exposure level at the moment, but don't want to take it any further unless, we get another left field event. So I'm just not quite sure what that might be.
And just to emphasize on that, the learnings going through the COVID, whilst the setup is different, but the learnings going through the COVID pandemic and that snapback in equity markets, just from a risk management point of view of managing the short book, taking profits on the way down, it's just, we've found that it's much easier to manage the net being above 0 than below 0. And if you think about it, a 20 to 30% net exposure is more like, if you adjust it for the volatility difference, is more like being market neutral, about 0% at those levels. And
if you look back at, over the 10-year journey, look, we've had 2 or 3 crises, and having, that lower net exposure has been certainly helpful during those periods. But if we run a slightly higher net exposure, on average, that a generally rising market environment, would have helped our returns. So look, we would like to be 10 or 20% longer over on average over the next 10 years than we were the last 10 years. But right now, 2022, with liquidity tightening, a massive commodity price and supply shock, that's not the time when we're increasing our net above historic averages.
Do you have a specific view on Zip and its current merger with Sezzle? I think you sort of touched on it before, but someone's asked, they might have just joined.
Yeah. Look, we've got short positions in both companies and have had for some time. Basically around the, as we've talked about the competitive landscape, but mostly, just the lack of operating leverage as customer growth continues, and the more revenue growth and the more customers, though, for both companies, it's true that the losses and the cash burn increases almost proportionately in the other direction. So there doesn't, the industry appears to be, trapped in a cycle of ever increasing marketing spend to try and maintain that customer growth. And that's resulting in ever increasing losses and cash burn. So I think, they'll be in a difficult position. Zip raised equity with the Sezzle deal, but I think it gets tougher for those second and third tier players, from here.
And just to add to that, pre the deal, Zip's and both Sezzle's accounts had come out. You'd started to see loss rates start to spike on their customers, and Sezzle has always been worse than Zip. So it looks like they're buying something that's even in more stress just to get more scale. But what's the point of scale if you actually have no advantage at scale? You're just going to lose more money. So we're still short there, albeit it gets smaller every day.
Okay. What about the investment process, I guess, and portfolio construction? You hold many positions around 130 at the moment. How do you stay on top of the analysis of this many positions? And do you have a screening process, or how do you analyse? What's the depth of your analysis that you think you can realistically achieve? So,
look, it's a lot of stocks, but we do tend to bucket them into those themes that we talked about earlier in the presentation. So, if we have a cautious view on buy now, pay later, we don't have to have all of our eggs in, a particular buy now, pay later stock, because you may find that that's the one that is the target in a consolidation move. Look, there's 4 of us in research. It's the same portfolio construction we've had for 10 years. There's actually more eyes on the ground than there ever, has been over the whole portfolio. We're only running the alpha long short strategy. Our high conviction long only strategy spun out. So look, it's nothing unusual for us, and certainly, one of the things I talked about in previous webinars was periods where you could have whole industries that were facing competitive pressure, like when we had the Royal Commission into the financial services sector in Australia, provided a range of companies that you could get exposure to that were negatively impacted by that Royal Commission. I think we're in an environment where you've got a range of companies that are negatively impacted by higher input costs. You've got a range of companies that are impacted by potentially higher interest rates. You've got there's been a lot of hurt in the tech sector initially, but the indexes globally have still held in relatively well over the last 3 months. And that's because money has rotated out of tech and into things like financials and cyclical stocks. Now, I think the Ukraine situation potentially puts those places that the market has rushed for safety at risk. Financial stocks have been performing very, very well over the last 18 months as the expectations are that interest rates were going to rise. But if interest rates, but what we're seeing at the moment due to Ukraine and concerns around growth is yield curves flattening and getting close to inverting, which is a bad setup for financials. So look, we've got almost quite a few industries that we could look at where you could take a range of positions in those industries on both the long and the short side. And that's been periods, in the past where the long book, or we've had a couple of industries working on the long book and a couple of industries working on the short book, that we've really, had a strong periods of performance. So, after a couple of years where it was difficult to find, industries or groups of companies where the short book was working, we've now got quite a few. We've got unprofitable tech. We've got, that potentially we've had the COVID beneficiaries, which now have become, the COVID losers, and the reopening companies, which were where the money cycled from the COVID beneficiaries into the reopeners. Now, if you look in markets like the US, things like the airline stocks, the casino stocks, the ticketing stocks, which performed really, really well around vaccine announcements, etc., are now, rolling over and going into downtrends. So certainly, one of the more interesting periods I've seen, as an investor over the last 10 years, and really exciting as a long short investor.
Right. Okay, well, unless there's any other things you want to finalise and summarise, Ben, I think we'll end there. We've had a few more questions that I'll get back to after the webinar, but do feel free to contact us at any stage with any further queries you may have. We appreciate you joining us today, and thank you very much.
Yeah, thanks, Lisa. We'll do these every 6 months, as we've talked about. It's a great way for us to be able to get in touch with our client base, and do feel free to reach out to Lisa, and Tim and I are happy to give you a call directly on our return. And if you're interested in some more takeaways after this trip, we're happy to share. So all the best, and thanks for tuning in.
Thanks, everyone.